Good evening, everybody. Thank you for joining us on today evening. We have with us Sorbh Gupta. Sorbh is the fund manager for equity. Sorbh has around 15 years of experience and he's with Quantum for around 8 years. Today we'll have a short presentation on how rate hikes can impact one equity mutual funds portfolio. Saurabh will take us to the presentation and we will have the question and answers after the presentation. My name is Sandeep Bosle. I head the customer interaction team at Quantum Mutual Fund. Thank you again for joining us. Over to you, Saurabh.
Yeah, so thanks everyone for coming across just before a long weekend. We thought it would be a good time to talk about what is happening around and how it could impact the portfolios, the mutual fund portfolios where one is invested, and what kind of exposure do you need to have in these times, or is complete exit an option at this point in time? A lot of people would be worried about their equity positions in mutual funds because of the uncertainty around us. So I'll just walk you through the presentation, maybe 20-25 minutes, and then we'll, as Sandeep said, we'll open up for question and answers. So now, a precursor to rate hikes, we need to talk about why is the need for rate hikes coming now. The primary reason is inflation, right? So post March 2020, when pandemic struck the world, there was a lot of supply chain changes that happened, or disruptions that happened, where global people could not travel, a lot of materials could not travel here and there. A lot of mining companies and other companies which were doing capital capex to expand capacities, that also did not happen. And when a lot of people got money, because in the developed world, the governments distributed money to their people to survive the crisis. Since people did not spend on services, they started to spend on goods. That resulted in the first round of sharp increase in the commodity prices. So if you look at the chart that I'm showing you right now, since 15 March 2020, which was like when the first wave of the pandemic struck the world and the world realized that pandemic is here to stay for some time. From that point, if you look at most of the commodities, they have rallied very, very sharply. Crude, if you see, it's up to 49%, coal is up to 68%. Across the board, everything is up. So that is the first round of inflation that came across very, very strongly to hit the world. Till last October, November, people had started to realize that this inflation is here to stay, but were starting to adjust to that. So companies which were able to take price hikes, they took price hikes, and everyone believed that, okay, in post-pandemic world, the prices would be a little higher. But in this Feb, what has happened, and I've given you that second table as YTD, which is the last 4 months, how things have moved up. Because of the geopolitical crisis in Russia and Ukraine, between Russia and Ukraine, and the world getting involved in it through economic sanctions, there has been further constraints in the supply of especially energy. So crude is up 70% and coal is up 200% because because crude is getting expensive, or the gas, so natural gas is getting expensive. People are moving towards coal. So that is another second or third round of inflation that has struck us, and companies are finding, because it has happened in a very short period of time, companies are finding it difficult to pass on. Eventually they will, but this is the basic premise. And because the inflation is high, central bankers need to tighten interest rates because they want to cool off demand, because there is a supply constraint. And that is primary reason you're seeing that interest rate hikes are happening. In about last weekend, last Friday, when RBI was also talking, though did not clearly raise hike. So they did not raise the rates, but they've indicated that because of inflationary pressure, the rates will go up. So this is how the world has clearly happened right now. So globally, whether the rates hike have been done or not, the interest rates have started to inch up. So if you look at, I've given you the graph, how the rates have changed in the last few months. So US, clearly there has been 80 bips change in last 1 year in the long-term 10-year bond yield. 10-year is the risk-free rate. Even if look at India, there is a close to 40 bips increase in the rates. So across the world, there has been the yields have tightened to factor in rate hikes and higher cost of money. So what is happening is because of this whole higher global interest rates. Now, since I'm going back in history a bit, post 2010-11, inflation did not, after the global financial crisis, if somebody of us have followed that, inflation was always muted, bearing the years of 2012 and 13. So last 7-8 years, inflation was not there. The money was easy. Central banks were not in hurry to raise rates. But that has started to change. So, and that is also getting reflected in flows. Now, what happens is that when the interest rates are low, it is easier to borrow money and put that money into any of other countries or any other instruments like equities. So for example, in US, if you would borrow at 1% and Indian equities are returning close to 5, 7, 8% dollar adjusted, it is a good decision to borrow in US and send that money to India and make that earn 5, 6%. But when US 10-year itself is yielding close to 2.5, 2.8%, this means from India, you will require higher rates of return, right? And when the expectation of rate of returns goes up, there is definitely chances that there will be outflows. And that is what is happening. So from a YTD basis, if you look at this year, FIs, and that red circle I'm referring to, FIs have already withdrawn close to $15 billion. And since October, that number is close to $18 billion. So that in the near term, those readjustments will happen. That will also impact stock prices of companies where FI holdings are high. So that is also happening. But yes, thanks to the strong domestic flows, markets have not fallen on their face because the domestic flows have supported them. Again, from an Indian perspective, there is also one more impact of whole this inflation and interest rate story is the pressure on currency. Now, India imports close to 90% of its oil requirements. Every $10 change in crude impacts our crude bill, the import bill, by close to $20 billion, right? So that's sharp money. So if you look at current account deficit, that is also expanding for India as we want more and more oil, and the cost of which is going up to $100, there will be pressure on currency as well. So as of now, it's still holding better because we have very strong forex reserve this time, not unlike 2013 when there was a taper tantrum and currency just slept through. This time we are on a very much stronger footing, close to $600 billion of we have close to $600 billion of foreign reserves, and that is equal to close to 10 months of our requirements of imports, net imports. So we are fine with that. But still, there could be a pressure on rupee, and as if oil continues to be where it is, and if it moves higher because of the conflict, there is a second level of impact on currency. Now, summing it up, coming to the bottom up a thought process of how high interest rates impacts your portfolio. So there will be two-level impacts. One is on valuations and second on profitability, right? So if you look at stocks that you own in your portfolios and our portfolio, mutual fund portfolios, there will be two impacts. First impact, I'll start with the second point, that is the easier point. Second point is highly leveraged companies will see pressure on earnings due to interest cost going up. So essentially, if company has borrowed money and it was borrowing earlier at 6-7% and interest rates tightens to maybe it goes up to 7-8%, the interest payout that it gives to banks or whomsoever he had borrowed, that will go up. And as it goes up, the profitability will be under a little pressure. So clearly, leveraged companies are disadvantaged in this situation. Right? So that is one level of impact on the portfolio companies that will happen. Second impact is definitely because, as I told you, interest rates are driver of the present value of any asset class. So whenever you are arriving at the fair value, it is the present value of future cash flows that you derive at, right? Whether you use PE multiples, whether you are DCF, ultimately, whenever you are buying a business, what are you buying at? You are buying the future cash flows, future how much cash flows that business will generate. Now, change in discount rate impacts that present value. Lower the discount rate, higher the value. It's very similar to bonds. So bonds, what happens is lower the interest rate, bond value goes up. Higher the interest rate, bond value falls. It's very similar to that. So what happens is that if you have understanding of bonds, what happens is that longer duration of bonds. So a bond which has a 30-year duration will be far more sensitive to the change in interest rate as compared to a bond which is like 2 years maturity or 2 years duration. Similar thing happens in equities as well. A high P multiple stock, which factors longer into the future, will be more sensitive to change in interest rates as compared to a stock which is low in P multiple and factors only 5, 7, 10 years of future cash flows. So a portfolio which is made of high PE stocks will be more sensitive to these change in interest rates. That is actually already started to happen. So high PE stocks and highly leveraged stocks are something which should not be in the portfolio. So ideally in this environment, a portfolio comprising of businesses with reasonable valuations and less leverage is the best suited right now. Now, that was more of a cyclical and short-term story. Overall, the long-term growth story does not change for India. India has, for the last 40 years, grown by close to 6.5%. So anybody investing in India with an expectation of 8-9% is not a great idea. Historically, we have grown at 6.5. That should be your base assumption of when you are looking at India as an investor, an equity investor. So that should be the base. And we don't see any reason why we cannot grow at that 6.5% for next few decades. And that will be the base for your equity returns. Now, coming to the basic expectation on equity from a longer term perspective, if your real GDP, as I told, should grow at 6.5%, and India being a little supply constrained economy, the inflation is at 5.5%. Your nominal GDP, which is inflation plus real GDP, grows at 11.5 to 12%. And as you would know, companies' revenues are in nominal terms. So the typical company operating in India will see revenues grow by close to very similar levels of nominal GDP growth rate. Profit growth of typical companies, assuming that the margins will be remaining the same and they will pass on the pricing increase in input prices, your profit growth should be around the same levels. And typical company which can gain market share, grow faster, should grow at 13 or 14%. And if somebody can pick up some winning stocks and winning companies at decent valuations, broadly, an intelligent portfolio should give you around 15% return annualized. So that is the broad expectation that you should anchor with. Bearing what is happening in the near term, there could be interest rates ups and downs, but this is the broad expectation that you can have with Indian equities in terms of your compounding of the money that you have invested in. Now, coming to whether it impacts the economy in the near term, what I was talking about in interest rates and inflation and other things, India post the pandemic, India was in a strong upcycle. It's the economic recovery right after 5-6 years of very slow growth and demonetizations and GSTs and other things. Finally, the economy looked to recover very sharply. And we were looking at two variables that was driving this change or recovery. One was strong hiring by IT companies. Now, IT is, though its share in GDP is not that much, but it gives a lot of consumption boom because IT companies give out 60% of their revenues as salaries. And if they hire more, clearly the consumption level goes up because more people are getting employed at good salary levels. And even the salary goes up very, very well. So if you look at the net hires, it's one of the highest in the decade. So hiring is very, very strong and it continues to be strong. And I was just listening to two of the management commentaries recently. TCS and Infosys have come out of their numbers. The demand outlook remains very strong and even the hiring outlook is remaining strong. So that trigger for economic recovery is sustaining. And in terms of residential sales, which got a boost by some stamp duty cuts, some price cuts, and because of lower interest rates, that has also picked up. That is also one of the highest in terms of last 5-6 years. And residential sales or real estate sales always has a multiplier effect because a lot of people will spend a lot of money in buying a house, then refurbishing the house or doing the interiors, and it has a very long multiplier effect. Once all things in place, so gives a very strong multiplier effect. So both these two tailwinds are intact right now. It may happen that the recovery gets delayed because of higher cost of fuel and higher input costs and consumption gets hit in the near term, but we believe that economic recovery should continue. It might get delayed, but it doesn't appear to get derailed right now. Now, again, in terms of earning upgrades, after 7-8 years of sluggish earnings, and this is a chart of Sensex companies earning upgrades or downgrades, what we are seeing is that finally the upgrade had started to happen post the pandemic. So earning upgrades were happening for Sensex companies in last 2 years. And we have to see whether this sustains or not. Near term, clearly there will be margin pressure for companies, and I think markets have started to factor that. But we believe some of the companies, if the demand remains strong, most of the companies should be able to pass on that input cost pressure, and the margins should revive in the second half of the year. So this would be a very important feature to watch out for, whether the inflation impacts the earnings on a more structural basis or a longer term basis. But we believe it will still be a short term phenomena. Demand being strong, companies should manage to do well, and this corporate earning upgrade cycle should continue. From a valuation perspective, there is some relief post the spike after the pandemic. So that spike that you see is primarily driven by lower earnings, because 1 quarter of earnings was missing because of the lockdown. But still, the market continued to remain expensive, and finally it's trending down. So P multiples have corrected, and value managers like us are getting a lot more opportunities now to see and watch and select companies. So valuation is starting to cool off, and one reason, as I highlighted, to cool off valuations is definitely the rise in interest rates. As interest rates start to move up, some of the highly valued companies within the index or outside index will see valuations cooling off, P multiples trending down if the growth rate does not pick up more than what it can compensate for the rise in interest rates. So we believe that there will be a lot more opportunities for a stock picker in this environment for next 1 to 3 years if the interest rate normalizes after 7-8 years. From a fund perspective, you would know that quantum long-term equity value has 3 broad guardrails to invest. There is a minimum liquidity criteria of $1 million daily trades. So we offer a very liquid portfolio where buying and selling into the portfolio is very, very easy. In fact, of the 30 stocks that we own, 29 stocks that we own, 28 stocks we can liquidate within a day without any impact on the NAV. Valuation remains a very important guardrail, again, because we are value managers. We don't want to overpay for any stock. And given the interest rate cycle that it is reversing, I think things are falling in favor for people who respect valuations. So for last 4 or 5 years, people who had thesis that quality at any price, you buy stock at any price, doesn't matter if the quality is great. But then again, markets and interest rates are suggesting that things would again move back to people who think that valuations are important, and it's important to think at what price you are buying which asset. And governance remains very important factor. We would not like to buy into companies which are crony capitalists, and even if they have a very large weight in the index or they're giving very fair return, we believe this, if you are a long-term investor, we have to be very careful about the promoters. In our founders word, it is very important to, when you shake hands with anybody, that you get your all 5 fingers back. That is the most important criteria of giving money to anyone. And investment, you actually are giving money to someone else to manage, right? So that also is a very important guardrail for us. From a portfolio positioning perspective, our portfolio is positioned for economic revival of what I was talking about. So consumer discretionary is close to 17%. Financials, we see a lot of value. It's close to 31% of the portfolio. Materials, again, is 9%, and utilities is close to 9%. We still await some consumer staples to correct. They have been cooling off last 1.5 to 2 years. They are not giving returns. They're kind of flat. So there is already a time correction that is set in consumer staples because of high valuations and input cost pressures. I think it will still, if this continues, you will see some staples coming through within our valuation band to get into the portfolio. Again, I highlighted upon being aware of not having leveraged companies in the portfolio. So we did a stress test analysis of our portfolio. So financials are close to 8% of 8 of the total 29 stocks. 8 stocks are financials, and of the 13 companies are companies which are net cash, so they don't have any debt in the portfolio, in their balance sheets. within our portfolio companies. For 6 companies, debt to equity is less than 0.4, and 2 companies have higher net debt to equity, but they are utility companies. So utility government companies have fixed ROE businesses, so they can carry higher debt. So that debt is not troublesome for them because it's all passed through for them. So that's how in the stress test, the portfolio appears very, very strong, even from a leverage perspective. Valuations, again, very, very attractive. If you look at a trailing 12-month basis, our portfolio is trading at 18.5 times vis-a-vis index, which is trading at close to 30 times. 1 year forward, we are at 16 times vis-a-vis index at 22.3 times. And if you look at the growth rates, and these are consensus estimates, not our internal estimates, the portfolio offers very similar growth profile at much cheaper valuations, much attractive valuations. So both the criterias of lower leverage and lower valuations get passed through in our portfolio. So 2016 to 2020 was a time for growth managers. What we believe, with increase in interest rates and cyclical starting to do well, we believe that value will again do well. It's already started to do well, but in patches. So Jan to August, value did very well. Then again, 4 months growth did well. Again, this Jan value did well. So it's been patchy, but as interest rates firm up, this will be a more longer term construct. The way it happened between 2000 and 2007, I've given you the chart, where MSCI World Value stocks did much better than MSCI World Growth Funds. And this is the environment we are getting into, where higher interest rates and cyclicals doing well, value strategies should do much better than growth strategies. Summing up all, we generally suggest an asset allocation strategy, which is a very important strategy. So what we suggest is a 12-80-20 strategy to all our investors. So whenever you are looking for asset allocation, how you should do it is that, first of all, whatever your monthly expenses multiplied by 12, that is your 12 months expenses, should be set apart and kept in a very safe liquid fund or a bank FD, because that is not the money where we like to take risk or any chances. So that money is separated out. Of the remaining money, 20% should go into gold. Gold might look kind of non-exotic for a lot of people who are looking at Bitcoins and other stuff, but it's a 5,000-year-old asset. And it stands out. So if you look at what happened in 2020 when pandemic struck, first 3 months, gold was up, equity was down 40%. Next 9 months, equity was up 40% and gold was flat. So it gives a very beautiful diversification to anything which is going wrong in the world. If everything goes right in the world, equity does well. Everything goes wrong in the world, gold does well. So it's a very nice diversification tool that you need to have in your portfolio on a longer term portfolio. Within equity, 80% should go into equity because you need to grow your capital to achieve your financial goals. Within that, you can allocate 15% to a quantum long-term equity value fund, which is your anchor fund, value-oriented, prefers capital preservation. 15% to new age investing like ESG, and close to 70% you can allocate to fund of funds, which is a bouquet of funds which has all type of strategies from other fund houses. It's a fund of fund product. So it has a growth product. It has a value strategy. It has a mid cap. It has small cap. So close to 8-9 mutual funds put together comprises this fund of funds. So that completes your basket of investing for a long term. You can have a regular revision of what is happening in the portfolio, so just to be updated. But this is kind of asset allocation that is required for your long term goals, like maybe child's wedding, child's education, or retirement. So we have this within our portal. We have just initiated this. If you want to create this 12-20-80 and you want to see how's your current portfolio deviating to this 12-20-80 plan, you could just visit our website, and few clicks you can just find out how are you positioned right now and what is the ideal allocation that you need to move to, so that you get that mix of 12-20-80. So this is a very important tool that we have created. I think you must visit our portal and use this. This is all free for you. So definitely try this out. So by this, then maybe I'll just end this presentation and open up for question and answers from here on.
Saurabh. Yeah. So thanks for the short presentation. So we'll have some questions in the chat. Anyone would like to ask questions to Saurabh, can please type in the chat box. So we have the first question. Thanks, Madhusudan. This is on quantum long-term equity fund. Now Madhusudan wants to ask that how much or what is the current AUM of your quantum long-term equity fund, and is it able to sustain compared to the last FY since there was an exit pressure or some investors want to redeem across in quantum long-term equity fund? So what's your view on this?
Yeah, so we quantum long-term equity AUM is close to 850 crores, and with similar strategy in quantum tax saving fund, both together should be close to 1,000 crores, a little less than that. In terms of sustainability, yes, we are a very well-funded organization, and we run very similar strategies for some of our FII clients on the parent side, Quantum Advisors, which is a $3 billion strategy. So in terms of sustainability, we don't face any issues. Yes, there was some bit of pressure on redemptions, but that has tapered off much of it, and our AUM is quite stable right now. So we are not necessarily worried. And overall firm AUM is close to $3 billion. So I think nothing to fear about sustainability of quantum right now.
So how is the quantum long-term equity fund performance compared to benchmark over the last few years? Has it improved now, or can you share some data on rolling returns or any other data?
Yeah, what has happened is that, as I told you, 2016 to 2019 was very tough for any value managers who was practicing value strategies, uh, with all due respect to value style. Post 2020, when the markets fell, finally value managers like us managed to get opportunities to invest in better businesses, where we did so. In the 15 days of March, when the markets fell, our cash levels fell from close to 12-13% to 5%. So we deployed 10% of that cash. Post that, the fund performance has improved considerably. Yes, we got some setback, in sense that because one of the companies, if I name Reliance Industries, which is a very big weight in the index, that did extremely well in the next 6 months when the market started to recover. Till December, only because of, if you remove Reliance's performance from the index, we outperformed the index by 500 basis points. But unfortunately, there are now some very large deals, and our view on their corporate governance is not something that we would like to invest, so we don't invest in that. So from a benchmark perspective, that was a hit that we got, but on a standalone basis, you could see that our performance improved considerably. That better performance continued next year as well. So in 2021, if you look at that calendar year, from Jan to August, our outperformance vis-a-vis Sensex was 800 basis points, and vis-a-vis BSE 200 was close to 550 basis points. Right? But again, September, October, November, next 4 months was again very, very tough for people like us, where in 1 month, Reliance moved by 15%. In 1 month, very highly valued NBFCs or companies which were prohibitively expensive. So market again started to exhibit features of growth stocks. And then again, the performance took a knock. Again, January has started on a good note. Markets corrected. We have corrected a lot lesser. Again, this month has been good. So what I'm trying to say is that I'm not trying to focus on very short term, but what I'm trying to focus is that value style seems to be coming back strongly. 2016 to 2019, there was no scope for value managers to do well or pick stocks. That is changing. Our portfolio, we are getting a lot more opportunities. We are discussing a lot more on stocks. In patches in last 2.5 years, the performance has improved considerably. But yes, as this whole value theme picks up, because interest rates are moving up and world is normalizing in terms of cost of money, and that was missing since 2013-14. If you remember, if anybody who were reading about what is happening in European bond markets, they were yielding negative yields. So bond yields in Europe was negative for long period of time. Right? Mortgage rates were like 0.5%. All these things are changing. So for a value manager, it is important that the cost of money improves. Right? There has to be a cost of money involved in your decision making. And once that is coming back, people like us are making a lot more sense while we are talking about. So last year, a lot of people did talk to us and did ask us why we are not buying these high flying names like consumer tech names, which got listed recently at obscene valuations. I can't even talk about valuations because next 6 months, next 6 years, they will not even generate any cash flow. So how to value these companies? And we clearly steered clear from these names, right? And we have thankfully saved our investors from those kind of accidents. So we need to practice those precautions. Sometimes what happens is prudence is not rewarded, but in long term it gets rewarded. So hopefully things are improving for us. Things are falling in place for us, and it will continue.
Thanks, Saurabh, for giving that, and also reiterating the quantum philosophy. Yeah. Now again, coming back to interest rates, how would be you view interest rates for the next 1 year?
No, interest rates are clearly moving up. Inflation, I think 40-year high inflations in US, UK, and most of the developed world. Within India also, interest rates are moving up clearly. So directionally, yes, interest rates will move up. Yes, what are markets pricing now and what actually it will be will differentiate the market performance. So market is everybody has built an expectation that interest rates will go up by close to 50 bips or 75 bips in India, and US and UK it will be higher. So that is something which market knows and it seems to be factoring in right now. But we have to see the trajectory of the inflation. If inflation trajectory does not cool off, interest rate hikes could be much sharper. But yes, next 1.5 years, until unless there is clear change in fortunes or there is a drop in commodity prices very sharply, which cools off inflation, which we are not seeing right now, interest rates will continue to move up for some time.
Thanks, Saurabh. Now, Saurabh, this is an interesting question by Joseph. Now, you said that markets and gold, just some time before, markets and gold are inversely proportional. Now, can we consider Sri Lanka as the worst case scenario? And if it was a worst case scenario, in that way, have you taken a closer look at how investors in Sri Lanka did during this current crisis? And did gold did good? And what about the stocks?
Yeah, so frankly speaking, I did not have a look at what happened to the stock market, but because the currency has depreciated very sharply in Sri Lanka, gold in the local currency would have just shown. Because when the currency loses its intrinsic value in any country, it's the gold which retains the value. Right? So gold must have done very well in local currency. And given the turmoil where the countries defaulted on its external debt, I don't see any reason why equity would have done well in Sri Lanka right now. Now, I think it will be a very extreme example to believe that could happen in India. India is a very separate country. We have reserves I talked about and other aspects. So that's an extreme case. But yes, rightly said that gold protects you with this kind of environment and this kind of expectations. World around us is a lot more uncertain now after pandemic. One, nobody factored a pandemic in any of our models, neither the investors nor us. Nobody factored that a developed country will actually attack another developing country, and that also has also played out, and the war is not stopping. It's more than 50 days now, and the whole world is just watching, doing nothing. And now in our neighborhood, countries are starting to default, and this default will continue if for the marginal countries who import a lot of energy needs and food needs. This problem will continue. Thankfully, in India, we are self-sufficient in food, and for energy, we have enough sufficient buffer in terms of forex reserves. So we are not worried on that front. But if these prices continue and this kind of inflationary environment continues, you'll see a lot more marginal countries to default, and you'll see coming back of real political crisis in some of the countries which are facing a lot of issues to provide food and energy to its citizens.
Saurabh, can you share any examples in the India market in the past, how gold has supported the investors when equity markets were not doing good?
Yes, there are multiple examples, and if you've heard of our historical presentations, which you can find it on our YouTube channel. A lot of presentations are there, and even on our Twitter handle. We clearly showcased some of the slides where when equity does well and when gold does well. So 2008 again was a time where gold stood out and equity fell by close to 40-50%. That was the global financial crisis time. In 2013, again, very similar thing happened when taper tantrum happens. Gold did well, equity fell. And closer home, 2020 is a very classic example. First 3 months, gold up 20%, gold, equity down 40%. And just post-March, when central bankers rushed in a lot of money and people believe that things are not that bad, equity just rebounded very sharply and gold was stable. So gold will do its work in these kind of pockets, and these pockets will continue to come in every 3-4 years. So as a diversification tool, gold is an excellent instrument.
Thanks, Saurabh, for reiterating the good point. Even if you look at our asset allocation 12-20-80, we do advise people to have your 20% of your portfolio in gold. Yeah. So Saurabh, coming back to valuations, what are high value P stocks that we should avoid? Would you be able to put some light on it?
Yeah, I will not be it will not be possible for me to give a lot of names because of compliance reasons. But high P is something like if your company is growing at 10-15% because it's perceived at very high quality and it trades at 70-80 P multiple. Look, for example, at the largest paint company, it trades at 90 P multiple. We all know there will be pressure points because of crude. However good a brand, you cannot pass on 50% increase in input cost, right? You have competition coming in, two new brands have already been launched. Still the stock trades at 70, 80 PE multiples. I'll give you more examples. I'll talk about, because since this is in public domain, I'll talk about Aisha Motors. So Aisha Motors was a very similar stock till 2018. Between 2013 and 18, everybody thought that stock is a never sell stock. It's a high quality stock, and it still remains a very high quality business. Right? In 2018, it touched close to 3,500 rupees. Right? Then a lot of changes happened from a government perspective, which increased the cost of motorcycles. Then pandemic happened where people were stuck at home. And now the input costs have started to go up. We had analyzed the business and we believed it's a very good business. But there can always be negative surprises because companies don't operate in a vacuum, right? There's an external environment which can turn really bad. The quality of the business signs out that company will survive, balance sheet is strong, but then there will be headwinds on the earning growth, right? So when we bought the company, we bought at 1,500 rupees in the March 2020 fall. So we are still in the money by 50-60%, but somebody in March 2018, he was thinking that it was a high quality company and it can be bought at any price. He would still be out of money by close to 30-40%. Right? So this is where valuation anchor helps, right? Sometimes the wait periods are long and could be painful, but that is where discipline is, right? So having a disciplined approach and buying the thing that you want to buy at a good price is extremely important. So I think that example would help you understand what exactly happens when you buy something at a wrong valuation.
So there's a question by Mr. Vijay. Now, this is on the Ukraine war. Now, he would like to have our views on two parts. Now, what is the likely impact of Ukraine war if it continues and if it stops?
Look, there is, from an Indian perspective, economic perspective, there is not much impact, direct impact. So directly, we do not import a lot of stuff from Russia, and neither do we export a lot of stuff to Russia. So that does not have an impact. Even Ukraine, very similar. One big import that we have is of edible oil, sunflower oil, which we can manage. So there is no direct impact, but there is an indirect impact. Indirect impact is because Russia is the world's largest exporter of oil, crude oil, and if you try to sanction them, there will be pressure on oil prices. So oil prices have shot up because of that, and we import 90% of oil. So there will be an inflation that will seep in. That is first level of impact. Second level of impact is that Ukraine produces about 6% of world's wheat, and it's, I think, 7th largest exporter of food grains in the world. Plus, it supplies, Russia supplies a lot of natural gas to fertilizer plants in Europe. So clearly, there will be some production losses on agriculture side, which is already resulting in sharp increases in agri prices, and this could sustain for some time. Again, from a food grain perspective, India is self-sufficient. We have enough food grains, so we don't find that pressure to come through. But we import a large amount of edible oil, the oil that we eat, palm oil or sunflower oil, we import that a lot. So there could be an inflation impact from their end. So these are the two impacts right now at this stage of war, which we could feel. If it gets worsens and people use different type of weapons and things, other bigger countries get involved in war, then it's a very difficult scenario to predict or paint. So I'll not be able to do that. If the war stops, clearly the cool off in crude will be the biggest boon that we can get, because economy is in a good shape. A cool off in a 10-20% cool off in crude will be very, very big positive for most most of the companies and individuals. So that will be the biggest benefit that we can derive out of the war. Kind of gets over very quickly.
So there's a question on what happened to your plans on launching an index fund similar to an ETF. Will it be tracking the index of Nifty 50 only? Any idea when it is expected to open? So we had filed for the product, we got the approval, but due to a SEBI regulation, April, May, June, there will be no NFOs launched in the industry. So we are awaiting for further instructions and further guidelines. As soon as they come, we will surely communicate to all of you. So, Sorbh, there's another question by Mr. Mohit Bagdi to everyone. Now, which sectors have a bullish trend in the next 1 to 2 years? What's your point?
Yeah, so not from a 1 year perspective, but yes, I can tell you where we are positioned. I explained it to you. So cyclicals is a place where we believe will be the maximum earning upgrades happening. By cyclicals, we mean consumer discretionary, material, and BFS, banking and financial services. We clearly see a lot of earning upgrades happening on those companies. So our portfolio positioning reflects that, because when an economic recovery happens, credit demand goes up. Most of the banks are very well capitalized right now, so growth will pick up over there, and their valuations are also attractive given the what the historical valuations are. So they're attractively valued. So we have a decent position in banking and financial services. In material, again, we know there is a lot of infra push by the government, but we don't find a lot of good corporate governance companies in infrastructure. So the only way to play this cycle is through some building material names like cement, high quality cement names. So that's also part of the portfolio. We believe it will do well. That's second. And third is we are a bit of contrarian over here, but we are betting on consumer discretionaries like auto. As cyclically things improve and a salary level or income level of people improve, and economy opens up, and people will like to commute a lot more for their work. I believe we believe that mobility consumer discretionary should do well. They are very, very attractively valued right now. Great ROE businesses, net cash balance sheets. So that's where we are placing our bets right now.
So sort of some questions which we had received on email from our investors just before the webinar. This is more from the macro point of view. Is a rate hike a right move by the Fed? And also, when will be the current uncertainty will settle down?
In terms of, I think not much choices when the country's inflation is at a 40-year high. Not much choices are left with the central banker but to increase rates. So initial period, they continued to say that last year, all through the year, they were saying that the inflation is transitory, means it will pass off. But finally, they had to bite the bullet and they say that it is not transitionary and it's here to stay. And it's 30-year, 40-year high on inflation. So I don't think so Fed or any other central banker has a choice but to not increase interest rates. So that interest rate will go up. From an uncertainty perspective, the variables are inflation is a big variable that will drive interest rates. And then again, this war. If war gets, Sandeep.
Other than what, do you see any global factors affecting the markets?
Interest rate itself will have multiple effects. For example, one is the impact on flows, right? Anybody who is bringing a model and expected rate of return will have to factor higher rate of interest. So that is one thing that will change in the world. So that is a big change where money flows from here. That is one change. Second change is definitely this geopolitical crisis that has erupted. So that needs to get resolved, because that is the biggest uncertainty of cooling off the energy prices. So that is one uncertainty. Once that gets over, we will see a lot of relief. But you never know. The world is, few countries are already seeing a fourth wave of COVID, and COVID seems to come back every 6 months. So we are still not writing it off. So this is also one of the variables that could come up. But from a bottom-up perspective, look, there will be no year, if you look back in last 20-25 years, where these variables have not come. You have to bet on real good businesses with good balance sheets, and somebody or funds which have factored risk and they do stress analysis on their portfolio and bet on that. If we continue to wait for a time where the world is perfect to invest, we'll not be able to invest, right? So there has to be a sense of optimism around the world when you are an equity investor. These things will continue. Our bet is that companies which are operating in the world have done their work. Now, to give you an example, when the world was shutting down, Indian IT companies operate with more than 500,000 people. The largest one, TCS, operates with close to 400,000 people at that point in time. All put together, there would be 1 million people working in IT industry. And the world was shutting down. And look at the way the companies managed that. Right? They not only ensured that people could 4 lakh people moving to work from home within a week, and no delivery was disturbed. So this tells you about the quality of process of the quality of business. Right? So if you are betting on right companies who can operate in tough environments and can adjust to things and have great balance sheet and decent management, macro geopolitical crisis is always an opportunity for an equity investor to buy equities which you like at good prices. So we should not be worried about this geopolitical crisis. This will continue. Today is Sri Lanka, tomorrow will be Pakistan, day after that will be Afghanistan, then Somalia, then Nigeria. This will continue.
Thanks, Saurabh. That also takes care of a question. We had a very simple question for how do I start my investment for this year? I've done with all my tax and everything. Start of a new financial year. So that's a question by Mr. Joshi. We have been recommending our 12-20-80 strategy for a long time now. Do we need to tweak this mix in view of rising inflation or increase gold in the mix, or do we increase any composition of gold or equity?
Look, so this asset allocation is for long term. These cycles will come and go. If you have a 20-year horizon, and the asset allocation plans are for long term financial goal, which are like 15-20 years away. Right? If you have a 15-20-year horizon of investment, there will be at least 3-4 these type of cycles which have come and gone. Let us go back 20 years, 2002. From 2002 to 2002, there was a rate cut because there was a recession in US. Rates started to increase from 2004 to 2007. Then global financial crisis happened, rates were cut. Then there was a slight increase in rate from 2012-13, a little taper tapering for 3-4 years. Then again, rate cuts happened because of pandemic, and again, rates are going up. So in the last 20 years, there have been 4 interest rate cycles. So if you're a long-term investor, if you choose a good portfolio and choose good companies, you should not be worried about these cycles. And if you're investing in fund, the fund manager will take care of these tweaks and changes, ensure that the companies do not impact. So long-term investing does not mean that you just buy and go to sleep. It's a regular review process. And that is where active fund managers help. As an active fund manager, they will always review and relook at things. If there is a company in the portfolio which has exposure to Russia, the fund manager will factor that and try to trim that. So these things, I think, will always happen. So from a longer term perspective, you don't need to tweak and change your long-term allocations for 1 or 2 years for achieving optimum goals.
So sort of coming to debt strategy, someone wants to invest into debt funds. So what's your view? He wants to invest for around 2 to 3 years. Now, taking into consideration the interest rate movements or the duration of bonds.
Bonds are having a big sell-off. We generally do not recommend. We do have a liquid fund and a dynamic bond fund, but you would have seen that in our asset allocation plan, the bond fund does not find a place. There is a reason to it. Most people do not understand that bond funds can also be volatile. It's a dynamic bond fund because it runs a duration risk. It will be volatile to interest rates. So anybody who understands that can definitely go ahead and invest. But with interest rates going up, the bond fund manager has to be really dynamic to ensure that he moves the duration very quickly when the interest rate expectations are changing. It will change every 3-4 months. So, but yeah, within that bond fund also definitely suggest if somebody understands, he can invest, but please avoid the credit risk. Take the duration risk, but do not take the interest rate risk, but don't take the credit risk. So choose a fund which does not take private credit or below AAA credit, because that is a risk which can result in default and erosion of your capital. Interest rate risk, okay, if you understand there could be a risk, but it's not something which is unmanageable. So within the bonds, would prefer somebody taking an interest rate risk, but not the credit risk.
So sort of given that India has a high record exports recently, how are we factoring export growth potentials in our funds?
Look, so we are bottom-up research people. We do not factor we have a few macro assumptions in place in terms of long-term GDP growth, long-term inflation. But within our portfolio, we have seen exports doing extremely well for some of our auto companies. So fact of the matter is that today, as it stands, Bajaj Auto exports more two-wheelers than it sells in India. And that has been a key change in last 6-9 months. So we are clearly seeing that happening, that exports are doing well, and some of our companies are benefiting out of that. Whole of IT pack, if you see, best results in last 10 years. That's 16% of our portfolio. So some companies are benefiting out of it, and this China plus one is also helping. Where I was looking at some data that about in 1991, India's export to total GDP was 10%. Now it stands to 24%. So that's a trend that is improving. Our exports to US was 2.6% currently, which was like 1.6% about 6 years back. So exports are doing well. The Indian companies are getting more and more competitive, and a lot of Western buyers want to diversify out of China. That's also a tailwind that is helping. So some of our portfolio companies are getting a benefit out of that.
So this is a question on bank deposits. Is there any impact of continued negative real returns on bank deposits, on stock market? And will this compel even senior citizens who normally park their funds in bank deposits to high, rather than preferring high stock markets investing?
Yes, so last 5-6 years it's already happened. If you look at, because of low interest rates on deposits, a lot of money has moved into equities. Yeah, I think because of this whole inflation thing and interest rates going up, there will be slight uptick in deposit rates also, the way it is right now. I think the next revisions for next 1 year would be on the higher side on deposits. But again, within an asset allocation, deposits should be not more than what I said, 12 to 15 months of your requirements. Post that, if you are still some time away for achieving your financial goals, and you want to grow your capital, equity is the only place. Yes, for retired person, it becomes that much more challenging, because putting money into equities it's a bit more challenging, because you don't have any earning life left to recover if there is a damage on the portfolio. Yeah, so that is a bit of a challenge, but I see interest deposit rates moving up a little over the next 1.5 years, slightly, compared to what it has been in last 5-6 years, reflecting the interest rates and the inflation. But yes, to get a real positive return, it will still be challenging from deposits.
So this is an extension of the previous question only, when you explain about the Sri Lankan scenario. Now is the question by Mr. J. In worst case scenario like Sri Lanka, who would shell out money to buy gold, and which may have shot up in value terms. Can you explain a vis-a-vis Sri Lankan case like that about gold?
I did not get the question correctly, yeah. Sandeep.
So is in a worst case scenario like Sri Lanka, is that the government shelled out a lot of money to buy gold, and which may have shot the value of gold up? And that was this scenario in this?
No, I don't think so. Gold was involved anywhere there. I think the few things which I have read is that one, because 2 years of lockdown, their tourist revenues fell, and it's a country which gets a lot of foreign reserves from foreign because of tourism. So that money they did not have. Plus, the government focused on organic farming, which resulted in yields dropping by 30-40% for the country. So they went short on food. Plus, with increase in energy needs, since they don't have organic oil wells, or they do not have supply for energy, they are also dependent on imports, and the crude prices went through the roof. They ran out of their foreign currency. That's as simple as that. They don't have any foreign currency left to take care of that. Plus, you have a lot of debt towards China, because they borrowed heavily from China for their infrastructure, and that got stuck in the debt trap. So I am not sure how gold is involved in all this scenario within Sri Lanka.
Going at sort of our top sector rate is BFSI. What is the impact of the sector in increasing interest rate environment? Also, current inflation as per quantum is demand led or because of supply issues?
So So the first part of the question is that from a very traditional perspective, people will say that rising interest rate is not good for rate sensitives like bank, but that is not true. What happens is that to look it from this perspective, let us look at the liability side of the bank, any typical private bank in India. 20%, because they are now much more capitalized than their minimum required by RBI. So 18 to 20% do they have their own capital. So that in any kind of interest rate environment, the cost of that money does not go up for a bank. 40-45% is their CASA deposits, where again it's very sticky and you get it at 2.5%, and that also does not move up that sharply when the interest rates go up, right? So 70-80% of your balance sheet is secured when interest rates go up. Now coming to the advances side, most of the banks have most large exposure to floating rate of loans, right? So when interest rates go up, their rate also go up. So it's actually a positive scenario for large banks rather than negative scenario. That is the first part. Second part is, as interest rates go up, bank, because its deposit rates are not going up as fast, will have an advantage over any NBFC which has dependence on wholesale market where the rates have gone up substantially. So there is a chance of market share gains for larger banks as well. So that's one of the reasons that we feel very constructive about banks in this environment.
Sort of as there's again an extension of the same question from the same investor. Why is Quantum not diversifying its mandate to include overseas stocks, where we can have some value picks from time to time? There may be a current, obviously there is a current bang on overseas equities, but which will be eased at over time.
Look, what we believe is that this generally complicates the product. Like, you are buying a product for certain X reasons, and those things get complicated when we start to do something like this. Because the mandate that we have promised and whatever the return profile that you see historically, it's not reflective of the fact that we can buy into some overseas companies. Plus, Quantum as a house will never put out or do something where we have not done enough homework. So until unless we have a team based in India, or we can regularly interact and meet managements. So meeting the management is an extremely important criteria for Quantum to invest in a company. And I'm not sure these larger companies would ever like to meet us given the size of Indian firms are. So we have to rely on the third party brokerage reports, or just hear a call sitting out of India, and then based on that we have to decide. So I'm not sure how good and effective active research we can do. It will be again a more theme-based investing. So when we say we are bottom up and we do these kind of things, this is more of top-down approach, that we believe that okay, consumer tech advertising will do well, let's buy Google, or maybe consumer tech will do well, let me buy something else, something else in US. I'm not sure this will be the right thing. In terms of overseas investing, we believe it is a diversified opportunity for any investor if he is looking for diversification. Till now, very late, the only way to diversify India risk for any retail investor was buying into gold. But because of this advent of ETF and foreign investing, you can definitely diversify your basket. But again, the product should be a very pure product, and you should know what you are getting into. So once you have seen that, okay, 5% of my allocation could go into foreign equities because eventually I want to send my kid overseas, or whatever the reason may be. But then you get into a pure play of that kind of product and make it part of your asset allocation instead of complicating a single product through different side of investing. So now maybe those foreign stocks or US listed stocks are in vogue. Tomorrow, what happens when China starts to do well and there are 4 stocks in China which does well? Does somebody has a capability to look into Chinese stocks and buy? And after 5 years, Japanese stocks start to do well. Does somebody create a capability to buy into Japanese stocks? It's not easy. Do you understand the risk? Does one understand the risk? There is a very good company called EPAM, which was based out of Ukraine, one of the finest IT companies. And focused on totally digital. Whenever you talk to Indian IT companies, they would talk very, very respectfully about EPAM and what is happening to EPAM, because 70% of the delivery of services were from Ukraine. The company is into tough times. They are now hiring a lot more in India to take care of that risk. So these type of risks sitting out here in India gets very difficult to understand for us. So we don't know. So some of the larger companies look very attractive, but do we understand how antitrust works in US, which could kind of create 10 Amazons in one passing of law? We don't understand those risks. So we have to be careful, right? And we have to have a dedicated team or an FOF strategy to buy, to offer to customers that, okay, this is this product and this is the risk that it can have. And then if you are okay with that risk, please make it part of your asset allocation. Right? Instead of making it complicated, let's make it simple. I'm not saying that it's a bad investment, but understanding of that risk and making it part of asset allocation after proper understanding makes much more sense.
So, Saurabh, again, you mentioned about asset allocation. Now, there's another question. You may have to reiterate what you said. How often we have to rebalance our portfolio? Now, Mr. Joseph is talking about 12, 20, 80 because of, and this is because of market movements and gold prices. Or will allocation look different at any point of time? The question is again, how often we should be rebalancing so that we can benefit, or should we, as an investor, should stick to 12, 20, 80 for his complete period of investment?
So directionally, you have, whenever somebody is starting off, he cannot start with that 12, 20, 80, right? Incrementally, you have to move. There is no point that if the markets are at very high and today morning you decide your asset allocation, you do that. It's a progressive process, and every 6 months you need to review that whether directionally you are moving in that direction or not. So eventually, you have to achieve that. So a quarterly review or a 6 monthly review is extremely important for any asset allocation. You just cannot be static over there. And to start off, you just cannot start off with that 80-20. You have to see how are things, how are valuations, and incrementally you have to move either through staggered way of investing into equities and gold. So best approach is having a staggered approach. First, you move out your 12 months of expenses, keep that out separately. And then once you have done that, then maybe a staggered approach both in equity and gold will ensure that you achieve that objective.
Fine. So what's your view on now, just moving out of equities? What's your view on silver ETF? Is there any role this plays in your strategy, or especially is a silver ETF or better for a long-term allocation?
Look, we are not offering any of this product, and I as far as I understand, I'm not sure whether it is an offering or not. So I'll not be in a position to say whether it's a good decision or a bad investment to invest in silver. What I understand about silver is that silver is somewhere in between. It's also a noble metal, but also an industrial metal. So it has its industrial uses and acts as a defense to inflation. Right? Personally, I always believe that one should be puristic in his approach. If I'm buying it for diversification, protection of value, let me stick to gold. If I'm looking at industrial, if economy is doing well and there is an industrial demand for certain metal, let me look at copper, right? So copper is a proxy to industrial development. Gold is a proxy to diversification, and anything going wrong, it protects my value. So I have a very clear bifurcation, but I have a very limited understanding on silver, its dynamics. So please don't take my advice, but that is why my personal approach is that first find out what are the drivers of silver prices and then take a bet. Because don't buy it just for the novelty of it, that there is an offering, let me buy it. So first understand why are you buying it.
Nice. Saurabh, one more question. We are coming to the end of the questions. Is there any relation with bond price, a company with the stock price of a company, how they are related?
In a normal course of thing, no. Bond prices would reflect. So bond prices comprises of two type of risk. It will factor two risks. One is the interest rate risk, and another is the credit risk or the default risk. The interest rate risk part is not related to equities directly. Right? It will move according to the interest rate cycle for a bond of a company. But the default risk is related. If the company is about to default, the stock price will also tank. Right? Because in the value chain, whenever there is a liquidation of a company, it's the bondholder who will get an advantage over the equity holder. So whenever there is a liquidation of any company, first, external creditors have to be paid out, workmen has to be paid out, government taxes have to be paid out, and if anything is left, it's left for the equity holders. So when the company is at the risk of default, yes, the bond prices and the equity prices will reflect the same factor. But in case normal business scenario, when there is an interest rate up and down, there is a possibility that there is a spike in the yield, but does not mean that the equity will reflect very similar facts.
Thanks, Saurabh. Thanks, Saurabh, for the brief presentation and the detailed answers that you gave to us. It was a pleasure to be with you. Any parting remarks would you like to tell to our investors?
Yes, so I believe that these are trying times, but these times will come and go. Anchor your thoughts to long-term investing and do not get anchored to this all noises of geopolitical risks. So if you go back in history, all these macro global geopolitical risks are actually great opportunities to buy into equities, be it 2008, be it 2013, be it 2020, right? So these are the opportunities. Don't focus too much on that. Buying a decent fund which understands the risk, and or if you're a direct equity investor, you understand equities, buying decent companies makes sense. Sit back, relax for long term, review it regularly, and then it'll do the work for you. No point understanding the whole global macro, it actually impugns your decision. Having a staggered approach and a disciplined approach makes more sense. And one final thing, I'll request everyone to just follow our Twitter handle. We give a lot of information. Our newsletters get posted over there. Follow our YouTube channel. All of our historical presentations, a lot of smaller views and snippets are out there for anybody who wants to understand quantum products, philosophy, and even markets. Historically, what we were saying when things were going not in our favor, and if we have made mistakes, have we explained those mistakes? You'll find all those things, all those videos over there. So request you to see our set of speakers and other people presenting in different points in time and what they were saying, to have a better understanding of quantum, its products, and the philosophy, and definitely the markets. Hope this session was helpful for everyone.
Thank you, Saurabh, for giving your time. Thank you all of you for attending this webinar. If you have any more questions, you can write to us at customercare@quantumemc.com. We will be glad to answer those questions to you. We will be coming up with more webinars and solving your queries. For our existing investors, you can always log into your Invest Online section. We talked about asset allocation 12-20-80. We have built a beautiful tool there where you can balance your portfolio there. For new investors, you can get in touch with us to know more about 12-20-80, and how you can do your allocation. Thank you all for attending this webinar, and Saurabh, again, thanks a lot for answering all our queries. Thanks a lot. Thank you. Stay safe.
Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.